Welcome back to Switzer. Well, it's been a big week for stocks with reporting season giving us a chance to shine the spotlight on good and bad performers. To see what an expert is seeing, we have legendary fund manager Anton Tagliaferro of Investors Mutual to pass judgment on the company results so far. How are you, mate?
I'm good, Peter.
What's it like living this legendary status of yours?
Well, you're the guy who says it's not me. So, yeah.
All right, mate. What have you seen so far that you thought that's a really good result?
Look, Pete, it's still early days. There's still lots of results to come. CSL obviously had a very good result. A few other results were a bit ordinary, I thought, and share price reaction.
Name one that you thought.
I didn't think Wesfarmers was a particularly good result today. I know the share price went up, and everyone's.
A 13.2% increase in profit, wasn't it?
Yeah, but if you look at the breakdown, Coles, Myers profits down 10%, almost 10%, in the first half, and they're saying it's going to get worse. And Coles has been the big driver for Wesfarmers in the last few years. They've been a bit lucky with the coal price, I guess, you call it luck. So, look, I didn't think that was a particularly good result. So it's a bit mixed. The CBA, again, profit up 1 or 2%. You've got a housing boom on. You've got bad debts at zero. Is a profit up 1 or 2%, a great result? I mean, fantastic dividend. And obviously, if housing stays strong, if bad debts stay low forever, it's a good company.
But you and I can go back quite a long time, and when housing sectors are doing really well, interest rates are never this low. That's part of the bank story, isn't it? Because interest rates being so low, that doesn't help their bottom line.
Well, yes and no. I guess it helps in terms of the bad debt staying low. I guess it helps in terms of making their dividends more attractive relative to cash. So there's pluses and minuses.
You've always got a good answer.
No, but
that's why you're here.
It's the banks are okay, nothing wrong with them. But again, I'd be a little bit cautious if you're taking a 3 to 5 year view as to whether today is the right time to be buying them when, credit conditions are so benign, bad debt conditions are so, got house prices up there. I'm just, yeah.
Let's look at a company. Do you look at a company like Domino's? Is that on your...
A little bit. It's a bit expensive, It's
but if it was
road company.
If it was at $43, would you say it's a good buy?
Oh, look, Peter, again, I don't know what PE it's at 43, but we'd have a look at it if it came off. But it's been re-rated, and this is, I guess, the problem. When expectations, get built into share prices, you have to be a little bit careful because the slightest bit of disappointment and, you can lose money two ways in the share market. You can lose money by buying rubbish stocks, because at the end you'll always lose money on those. Yes. And the other way you can lose money is if you pay too much for companies, And the problem with buying stocks where there's so much growth factored in and so much good news is the slightest bit of bad news. You saw that with Bellamy's, when the expectations are high, if things go off the rails a bit, bang.
Well, when I had Charlie Aitken on the show yesterday, and I said to him, how come Treasury Wine and Estates seem to have reported pretty well, but the market down? And Charlie said, well, often it's, buy the rumour, sell the fact. And he said, I wouldn't be surprised if it went up today. And it did.
Mind you, everything was up today, I think. But,
So just one tick for Charlie. But the bottom line is, when these companies are loved by the market, like Treasury Wine and Estate, and Challenge is probably another one, do you have to be careful that in many ways that there are buying opportunities when the market takes a set against them temporarily, or are we at
100%? 100%, and that's where we look. We're value managers.
You're a quality picker.
Well, we're quality, but we're looking for value, right? So when something's going ballistic, everyone loves it. We're a bit cautious. When something gets a bit out of favour, for example, Caltex, was all the rage a year ago, $38. Today at $28, come a 70-cent dividend, which it was last week. It's
so you
very
still
well
like
managed.
Caltex? Do you still like Caltex?
At a price, everything's got a price, Pete,
Okay, well, let me praise you, because you stuck by Woolworths when no one was sticking by Woolworths. Has it been a good result for you, because the share price is a lot higher than it was when you...
I wasn't that bullish. I said hold. It's got a long way to go. But I think it's factoring in quite a big turnaround now. And as you saw from the Coles numbers, Woolworths are picking up share, but everyone knows that. But I don't think Woolworths will have a fantastic result. It's a tough sector. So, I'd say...
The market's run ahead of itself on Woolworths?
A little bit. I'd say it has, yes.
What about the threat of Amazon? Do you think that's something you can factor in your numbers?
On grocery sales?
Well, they reckon they're getting into that stuff.
I'm not that concerned.
doesn't
I'm more concerned about people. You know, you got Coles, Woolworths, Aldi, IGA, and everyone's fighting for customers. That's the biggest concern.
What do you make about the resource prices and the share prices of BHP and Rickard?
Yeah, incredible. You know, incredible. I don't think anybody expected it, and. But again, it's not an area of the market anybody really can predict with any certainty, you know. And only 12 months ago, everybody was concerned about the Chinese stock market collapsing and
that's looking better.
What all that meant for the rest of the world. Here we are a year later, and you've got I suppose you would call him a controversial type character as president in the US, and everybody's sort of off to the races.
Well, but Donald Trump in many ways has made your life easier, hasn't it? Because, you know, the Australian stock market's gone up more than I expected, probably more than you. It was definitely, you're always more negative than I am. So are you going to be sending him a Christmas card this year?
Well, again, Pete, the year's only just started. There's a long way to go. And if you look at volatility, as measured by the VIX index, it's at record lows, so everybody's very complacent. Everybody thinks the market's going to keep running for a long time, which is possible, but at some point it has to have a breather, I would have thought.
Yeah,
you know? And,
I'm thinking a pullback.
Well, the results are okay. As I said, some of them, when you look a little bit beyond the, you know, as I said, CBA, fantastic dividend, fantastic result, but, you know, profit up 1 or 2%. In a good economy is not great.
Okay, I'm not going to let you go unless you give me the company that you most like at the moment.
Okay, there's a 2 or 3 again. As I said, Caltex I quite like. It's bounced a little bit. Come a dividend, very good management.
Yeah.
I think all the bad news about the BP contract with Woolworths is in the price now. So I think, you know, next 3 to 5 years that'll do well. Yeah. Main Farmer's another one that got over $2, been smashed. Should have a very good result in the next when it comes out. And Ansell's another one we like, which has been you know, come off again since the result. They're selling off their condom division, which it sounds like there's lots of buyers there, so they should get a very good price, and then it'll become a buyback. So there's pockets of value, you know, in things which are disliked. All good quality stocks which are not trading anywhere near their 12-month highs.
As always, you over-delivered. Thanks very much, Anton.
Thanks.
Anton Tagliaferro of Investors Mutual. That's the show for tonight. Thanks for joining us. See you tomorrow night.